Hello, Mr. and Mrs. Kessler. Thank you so much for making the drive here today. I hope the weather wasn't too bad. Oh, good. Well, again, thank you so much. I know we're starting to get the busy season with taxes, preparation, but I wanted to be very diligent in scheduling time after our previous meeting to follow up with you on the financial plan that I put together. Please let me know. We're going to go over step by step with the financial plan, but please let me know if there's any information that maybe I misunderstood or that you have questions about as we kind of discuss some of the high level action items and planning strategies for you both to implement. So first, some basic information that I've collected from you both to build up our client profile. Both of you at this point are fully retired, and John, you recently retired yourself back in September after selling your business. John, you're a 71 currently, and Mary, you're 68. You both have children. You have Robert, age 40, who has 2 sons. You have grandchildren, Kevin and James. Then there's Elaine, your daughter, age 39, who has 1 daughter, Jill, age 11. Now, the scope of the financial plan is to prepare something that's very comprehensive, and that, of course, if there's particular areas that we want to follow through recommendations, we will circle back on those. And the purpose of all these planning is to really help guide both of you in achieving your financial goals and objectives. And it's going to cover a wide range of financial areas, financial health in general, risk management, investment planning, retirement planning, tax planning, and estate planning. So we're going to cover all those key recommendations, some strengths and weaknesses in each category. I'm not going to cover everything, as I mentioned. It all is included in this plan that I put together. But then at the end, we're going to really hone in on 4 action items for us to give us some marching orders and follow-ups potentially for future meetings. Revisiting with both of your client goals. The goal is to, again, create a comprehensive review of your financial situation, and it was conducted based on information that you have provided with us. This includes reducing estate and tax liability, ensuring that all the estate planning documents are in order, review insurance coverage, and discuss any implications with purchasing long-term care insurance for both of you. Reduce personal income taxes. No one likes to pay more than they have to, of course. And recommendations on asset allocation strategies based on your overall risk tolerance level, and looking to diversify some of your investments to meet your investment goals and expectations. Your investment expectation or risk tolerance based on our questionnaire that we've completed and that we've already gone over. You both are moderately high levels of risk tolerance and are looking to have some growth with your investments to achieve your goals. When we're looking at the overall plan that we put together, some basic economic assumptions that we built in is the expectation that you're probably going to be in the 37% federal marginal tax rate, and that inflation going forward is going to be 2.7% or more, and some investment terminologies with the risk-free rate of 2.5% and the market risk premium for investments at 8%. So looking at your overall financial health, we reviewed various documents to really establish what your financial health looks like. We looked at your overall financial position, which is what we call the estate or your balance sheet, the ratio analysis, and statement of cash flow. Overall, you have a very strong financial health. Together, you have a sizable net worth. Total net worth is north of $13 million, and congratulations on that. That is a significant achievement. And your net disposable income, which is bank cash that you have at the bank, is right around $600,000. I will note that you have a high current ratio of 29.5 42, and this compares your assets to your liabilities, your current assets, what you have readily available in the bank, and current assets or current liabilities, looking at your more short-term debt within a year. It's actually quite significantly high, which shows strong financial health and stability. However, too strong of a having too strong or too high of a current ratio can also be a sign of your cash not really working for you. Some concerns, of course, with having high cash can be the diminishing of purchasing power, and that's something to look at. So purchasing power is $100, for example, today is not going to be worth the same, have the same buying power. You're not going to be able to buy the same amount of items 10 years from now because inflation is going to creep up. And we're also looking at having significant cash. There's the FDIC insurance limits. That's, banks don't regularly default, but as we saw with some of the Silicon Valley banks in 2023, I just want to be a little sensitive to that. And with the insurable limits, it's $250,000 per depositor per issued insured bank for each account ownership category. So for you, that looking particularly at the CD that you have, John, you'd really want to potentially reduce that amount. You only need 3 to 6 months of readily cash available for emergency savings, and deploying some of that towards reinvesting some long-term initiatives. Another opportunity for the cash would be to pay down your current mortgage on the vacation home. Vacation home, the interest rate on that is 4.75%. That's the cost to you to continue with that loan, and with interest rates being where they are, that they could increase, might as well take some of that cash and pay down that liability. Is transitioning over to overall financial risk management. Having cash in the bank is great, but we want to make sure that your assets and all of your cash, investments, real estate is protected in the event of some type of loss. So when we're looking at your risk management, we're really trying to identify some weaknesses and strengths within your property and casualty insurance, as well as some other areas of insurance policies. I really want to talk quickly about your homeowner's insurance, both on your personal residence and on the vacation home, as well as your auto insurance. Those are 3 areas that really should be looked at by an insurance agent. I think that you maybe have some lapse in coverage. The vacation home seems to have at least enough coverage to cover the home should it have a total loss, but I'm not certain based on the type of policy if it has flood insurance, knowing that that particular home is located in a area that may be susceptible to flood. That is something you will want to consider. Similar with the boat, I'm not sure if there's adequate insurance between the homeowners' policies to cover any type of liability or property damage to the boat. Again, something to consider. When we're looking at the aggregate between all of your property and casualty insurance, you're going to want to consider an umbrella policy. Given the size of your total net worth, like I mentioned, north of $13 million, you want to purchase probably a umbrella policy at least $5 million, and the purpose of the umbrella policy is if for whatever reason the underlying coverage, whether it's homeowners or your auto, is not sufficient enough to meet the claim that is being proposed against you, then the umbrella insurance as an excess liability policy will kick in and hopefully insulate you from being personally held liable and having your personal assets be available in those type of claims. I also want to touch on long-term care insurance, which is a great way to also protect your assets, but looking further down, should you ever need long-term care facility needs. The idea behind long-term care is it's a product that you may or may not need, which makes it very difficult and it is expensive. Premiums can be quite high, which is why some folks, they opt not to purchase long-term care insurance, because there is that risk that you may be paying in significant premiums year over year and never need the long-term care policy to be put in place, which is good, but of course there is that financial side to it. So some folks will look at potentially life insurance, which may be a good opportunity based on you both having existing life insurance policies. Maybe that can be transferred or recategorized with something that has a rider on it. That way, if it ever comes to a point where you do need to tap into the riders, maybe you don't need something as robust, you need to tap into the rider's coverage, well, you can tap into it during your lifetime, but should you never need it, then the beneficiary of the life insurance policy will have the death benefit, so you're paying at least towards something as opposed to potentially something you may never need. And as we're talking about protecting your assets, looking at also your investments, because that is something that we're going to want to work with you to continue to grow based on your risk tolerance, but also be smart and very intentional. Looking at your overall portfolios, in aggregate, you've done very well. But when we're looking at the stock portfolio, there's only 4 stocks that make up that 900. There's only 4 stocks that make up that portfolio, and that's a pretty sizable portfolio. We really want to look at diversifying that particular fund. The mutual fund is done well in addition. That is a little more diversified. There's at least some bond funds. There's different types of equity-based funds. There's international funds. I will say that probably the international portion is almost a third of the total portfolio. You might want to work with us to further diversify, just because international funds are going to have some added risk to it. There's currency exchange risk and market risk, political risk. So maybe being a little more strategic about the different sectors or different types of international funds, just to move them a little bit more to something that's more comfortable for during your retirement. Another option as well, which would be looking at something that's a little more tax efficient, is purchasing mutual funds that are municipal bonds. They're going to have tax-free benefits for federal. Looking at overall with your other portfolios, so the 401k and 403b, the 403b that you have, Mary, looks pretty good. It's in what I believe a target date fund, which the point of those funds is for you, the retirement date's 2025, but over time they get slightly more conservative, maybe increasing the allocations toward bond funds, and reducing some of the equity and foreign-based exposure. Of course, there's still going to be some foreign and equity, some growth in there, because it is intended, those funds, to continue through your retirement. So they're not going to be, for example, 100% conservative as soon as you hit retirement date, but it's something certainly to look at. You both have these retirement accounts that potentially if you want to open up your investment options, we may want to consider rolling these over into IRAs. So right now they're in employer-sponsored plans, which tend to have a little bit more restriction or limited investment options. If you want to get more into individual stocks and bonds, to be more intentional about your investments, or ETFs, which tend to be very tax efficient, you could roll these into IRAs. And then what's great about the IRAs is even though you guys right now are at a slightly higher tax rate, you're at 37% marginal rate, in the next couple of years maybe your taxable income is not quite as high, maybe the installment payment is done at that point, and maybe some Roth conversions might make sense for really shifting over the tax benefits. So right now the 403b and 401k, even if you were to roll them over into a traditional IRA, those accounts are currently the investment income is tax deferred, and the actual distributions are going to be taxed as ordinary income. Now likely you can't complete a in-plan Roth conversion, so that's why if you were to do a rollover into an IRA, from there we could do a Roth conversion, which would be picking up those funds and moving them strategically over time into a Roth, which would allow, again, tax deferred growth for investment income, but distributions would be tax-free. Again, there's that 5-year rule after opening up a Roth IRA and conversion limitations, but if these assets are meant to be set aside for the next generation, what better way than to have the next generation inherit something that will not create any tax implications with distributions. Another great thing about IRAs in general is if you both don't plan on needing some of these funds for your retirement, which look at your overall assets, maybe you feel comfortable without these retirement accounts, well, you could do qualified charitable distributions if these accounts are rolled over into an IRA. Qualified charitable distributions are great because they are made directly from the IRA to the charity of choice as long as they are 501c3. And those, when you're in required minimum distribution mode, doing a qualified charitable distribution, not having to pay taxes, still meeting your requirements, is a good way to be philanthropic and save some money on taxes. Tax planning. So this is one of those areas that really depends year over year and even quarter over quarter. We're looking at various strategic ways. We talked a little bit about investments, maybe doing some reallocations with your investments. So maybe some of the investment growth is based on capital gains rates as opposed to ordinary income rates to push down that total tax liability. Also, if we're looking at long-term, being more strategic about growth positions as opposed to positions that are issuing dividends. And then, of course, municipal bonds are going to be federally tax-free. Those the interest. I also wanted to mention briefly about your 1918 inverted Jenny stamp. This has a significant gain, unrealized gain. I believe it's about $900,000 should you have sold it yesterday, which is pretty significant. And this may be one of those assets that if you truly think is going to have an annual rate return of 8%, perhaps you want to consider keeping that and leaving that to your next generation as part of your legacy. They'd receive a step up in basis. So if that 900,000 right now unrealized gain, should you have passed away yesterday, today if they were to sell it, they would sell it at fair market value, which likely would be the same as, or relatively the same as the cost basis, because that step up in value, with little to no tax liability to them. A few other quick things I just want to talk about as we transition to discussing estate planning. Some of my favorite areas of planning. Got my pages messed up. So when we're looking at estate plan, we really want to figure out who owns what, how things are titled, because the flow of the estate is all based on the ownership, the type of ownership. Looking at overall, there seems to be quite a bit of property that is owned individually that would be subject to probate. There's different strategies around what we call trying to avoid probate, and this is something the attorney working with an estate plan attorney can further help you with. But some of the assets can be either titled jointly as tenants in the entirety, which is a joint ownership between spouses. So if one of you pass away, it automatically transfers solely to the surviving spouse. There's also payable on death and transfer on death accounts. That's a great way to still keep the asset individually or keep an asset in someone's name individually, but almost attaching a beneficiary to that. A great example is with the Stark portfolios that you have, John, and the mutual fund portfolio you have. If you were to transfer those into a transfer on death, well, should you have passed away yesterday, Mary, assuming she was named as this beneficiary, would receive that step up in basis and could liquidate the account, be strategic, maybe rebalance it, etc. So again, it's just another tool that can be used. There's also trusts outside of using estate plans, or trusts outside of using the will, because the will again is going to be going through probate. And I will mention that for beneficiaries, you want to make sure all of your designated beneficiaries are up to date, particularly in retirement accounts. I know Mary, it looks like your designated beneficiary on your 403B is your estate. You should really switch that to a warm body, because that can create some state tax issues. So another area I will mention is your overall estate plan documents. You have your wills completed, which is awesome, but there's a couple other documents I would really highly recommend working with a estate plan attorney. Healthcare proxy and power of attorney. These are very important documents should one or both of you become incapacitated. So the healthcare proxy is going to name someone to be able to make medical decisions on your behalf, and a power of attorney is going to name someone who is going to be able to make the financial and legal decisions on your behalf. Now, this is really important because you don't want to be in a situation where your family is having to go through the proceedings of a guardian because you're no longer able to make decisions, you're incapacitated, and you have to go to the courts, which can take time, use a lot of financial resources to then name someone as the agent to make decisions on your behalf. It delays decision making, and again, it's just time, money, and it's stressful. I mean, the whole purpose of estate planning, in my opinion, is to plan for, you try and plan for at least the most realistic scenarios to make things easier for your loved ones during the most stressful times of their lives. And I guess with that, I'll pause and see if you have any questions about some of the material we covered today. Okay, great. So before we end our conversation, I wanted to touch base on some of the action items that we have going forward as we kind of move on, and some of our action items. Hold on one second. So the first goal, or the first objective that I would highly recommend and prioritize is insurance, because there's potentially some lack of coverage in what I think is very important areas between the flood insurance, not having an umbrella insurance policy in place. Those are going to be the most crucial from a liability standpoint to protect your overall assets. I have, as you know, I have a friend of mine. He's the insurance agent that recommended you to me. And I'm hoping that if you are interested, you are more than welcome to work with him. I will say that because of the referral, there is potentially some compensation for us, for me, but please consider shopping out your insurance. Get different advice from very professionals, and you go with who you feel is most comfortable for you, that is listening to your concerns, your even reviewing this financial review that I put together. And of course, if you have any questions about it, contact me. But to get the insurance in place, the estate plan to me would be number 2, because you don't have healthcare proxy and power of attorney. In those instances where you become incapacitated, you're going to want to speak to an attorney about that and really go through the planning process with them. Then purchasing long-term care insurance, as my opinion, would be would be the third on the priority, but you could probably talk to the insurance agent when you have that discussion. And I will say, contacting them this week, you're going to be able to get right in probably with the insurance agent, a very quick timeline, but the estate planning attorney, because it is approaching on tax season, it's going to take a little more time for you to maybe get some time on their calendar to meet and really put together a thorough review. The fourth that I have here down the list is diversifying your stock and bond portfolios and making them really more intentional, and minimizing any taxes due to investment income. And if you are comfortable with everything that I presented so far with the plan, after you take some time to review, I would love to be able to plan forward and schedule a meeting in the next couple of weeks to have you come back in and really review in more detail the recommendations that we've presented to you. And last, which is more of a, not least priority, but more of an ongoing discussion, is reducing your personal income taxes. I know that's one of the higher goals that you've mentioned to us, but to me, that is ongoing on a quarterly basis, especially with your investment income. We're going to want to review those right before you pay your estimated quarterly taxes. Well, if you're interested, we'd be more than happy to do the planning for you if you don't have a professional to work with. And year over year, we can do even a multi-year tax projection and really revisit that to figure out what strategies are going to be best to optimize in certain years. So if you feel comfortable, I'd be more than happy to schedule a separate meeting, particularly looking at tax planning right after you prepare your 2024 tax returns. I think that would be a great time to really refresh and focus on 2025, especially as we're looking at potentially doing some diversification with your investments. So we'll have that as more of a comprehensive conversation at that point if you're interested. Let me know, or feel free to give me an email or contact my assistant. Any other questions? All right, great. Well, I hope you both have a great rest of your day.